Imagine a giant stadium where the scoreboard doesn't show points, it shows debt. And every time the number climbs, nobody panics, because the referee can quietly add new chips to the game. That's the weird superpower of the United States. Not that it borrows money, every government does. But that it can borrow at a scale that would crush almost any other country, and still keep the world calm. Because behind the scenes, America runs a three-part machine. The Treasury, Wall Street, and the Federal Reserve. And once you see how that triangle works, you'll understand why the global economy is built on something far more fragile than wealth. It's built on belief. Start with the basics. A U.S. Treasury bond is a contract. You give me dollars today, I'll give you more dollars later. These bonds are sold in auctions. The buyers aren't just investors. They're institutions that basically run the plumbing of modern finance. Banks, pension funds, insurers, money market funds, foreign central banks. Why do they buy? Because treasuries aren't just investments. They're collateral, the thing you can pledge for loans, liquidity, and leverage. In the financial world, treasuries are treated like the closest thing to a universal, safe chip. So when the U.S. issues more debt, it's not only raising money. It's also feeding the system the asset it uses to stay liquid. That's where the story gets dangerous, because the U.S. is both the supplier of the world's safest chip and the biggest player who needs those chips to exist. Here's the core mechanism, without fairy tales. Step A, the Treasury borrows. The U.S. government spends more than it collects. To cover the gap, the Treasury issues bonds. Step B, the market absorbs them. Primary dealers and major institutions buy them, trade them, use them as collateral, and move them through the global system. Step C, the Fed can change the temperature. Now the crucial part, the Federal Reserve doesn't fund the government like a normal ministry. But it can buy treasuries in financial markets to influence interest rates and liquidity. When the Fed buys treasuries, it pays by creating bank reserves, digital balances inside the banking system. That can push yields down, ease financial stress, and keep the machine from seizing up. So the Fed isn't literally writing a check to the Treasury like, here you go. But it can become the buyer of last resort that prevents borrowing costs from exploding when panic hits. That's why in crises, you often see the same pattern. Markets freeze. Yields spike. The Fed steps in. Liquidity returns. The system keeps breathing. It's not magic. It's plumbing. And America controls the main valve. If a smaller country tried to play this game too aggressively, it would hit a wall fast. Its currency would fall. Imports would become expensive. Inflation would surge. Lenders would demand higher rates. Debt would spiral. So why doesn't the U.S. instantly collapse when it expands debt and the central bank expands its balance sheet? Because the U.S. dollar isn't just a national currency. It's a global operating system. Dollars are used to price key commodities, settle trade, and store reserves. And treasuries are used as core collateral across the world. Meaning, when the U.S. issues debt, the world doesn't only see America borrowing. The world sees the world's safest collateral supply increasing. That creates a strange feedback loop. Global demand for safety can support the very borrowing that creates more debt. But don't confuse support with infinite. There was a moment when the modern era truly began, 1971. The U.S. cut the direct tie between the dollar and gold. From that point forward, the dollar became a promise backed not by metal, but by confidence, institutional credibility, and the depth of U.S. financial markets. That shift was a power move. It gave the U.S. flexibility no gold-linked system could tolerate. But it also upgraded the system's hidden weakness. If your foundation is belief, then the real risk is never running out of money. The risk is running out of trust. People hear, the Fed creates money, and imagine cartoon inflation instantly exploding. Reality is more subtle. When the Fed creates reserves to buy bonds, that doesn't automatically mean everyone starts spending like crazy tomorrow. A lot depends on whether banks expand credit, whether supply can keep up, whether people expect prices to keep rising, how fast money circulates. That's why you can have long periods where the central bank expands its balance sheet without immediate consumer inflation. But here's the part that matters for ordinary people. Even if consumer inflation doesn't jump overnight, easy money can inflate assets first: stocks, real estate, speculative markets, because liquidity flows into financial channels. And when inflation does arrive, especially after supply shocks or massive fiscal spending, wages often chase it late. So the pain isn't always instant. Sometimes it's delayed. Sometimes it shows up as housing becoming unreachable, savings losing purchasing power, and normal life getting priced like a luxury. There's a question that matters more than any headline number. Who is absorbing the new Treasury issuance? If global buyers are eager, yields stay calmer. If buyers hesitate, yields rise, meaning the government's interest costs grow. And if yields rise too fast, the Fed faces a brutal dilemma. Let yields climb and risk financial stress, recession, or a market accident. Or step in with purchases, loosen conditions, and risk fueling inflation or credibility damage. This is where the system becomes a balancing act, not a cheat code. Because a reserve currency empire can stretch the rules. But it cannot erase consequences. History doesn't repeat perfectly, but it does have patterns. Some powers didn't collapse because they ran out of resources. They collapsed because their financing model became too heavy to carry. Look at Spain in the Age of Silver. It had oceans of wealth flowing in, but constant wars and debt obligations turned treasure into a treadmill. Defaults weren't about having zero money. They were about the system becoming structurally unstable. Different century. Different tools. Same lesson. When a state's survival relies on rolling obligations forward forever, stability depends on confidence staying intact. And confidence is a psychological asset. It can weaken slowly, then break suddenly. This isn't an academic debate. It reaches into your daily life. The interest rate on your mortgage. The price of groceries. The return on your savings. The stability of your pension funds. Whether cash feels safe or silently shrinks. Because when debt expands and money conditions loosen, the winners tend to be the ones closest to assets and credit. And the losers are often the ones paid in wages, saving in cash, living on fixed income. If you understand the mechanism, you stop treating inflation like bad luck. You start seeing it as a distribution event, a quiet shift in who can buy the future. So is the system a scam? No. It's more dangerous than that. It's a machine that works, until the trade-offs catch up. It can stabilize crises, fund deficits, and keep the world liquid. But it also builds dependence. And the longer dependence grows, the more the system becomes sensitive to one fragile thing. Credibility. Not gold. Not moral speeches. Not politics. Credibility. Because the reserve currency is not a crown you wear forever. It's a job you keep only as long as the world keeps hiring you. If this gave you a new lens on power and money, subscribe to Empire of Money. Because history doesn't just tell stories. It reveals the machinery behind the world you live in.